Very good morning, friends. So, a very happy Sunday morning, and I think it's a great day to start something new as well. So, we are now on the trail of, you can say, the consolidation standard, and which is also very important from the examination point of view. So, I guess when we look at the paper in financial reporting, say a final, I guess we really can't think of a paper if there is no consolidation. Just like financial instruments, I think consolidation also takes a prime, you can say, importance in the examination setup. And when we look at the consolidation chapter, there are a huge number of standards which are there in terms of consolidation, starting from Index 103, then Index 110, then Index 28, Index 111, Index 27. So I would say a bouquet and a plethora of standards indeed. So I think the very first thing, what we are going to do as our strategy continues, that we are going to first make a quick revision of the concepts and start doing some practice questions also with you. Now, since this particular standard involves a plethora, a bouquet of standards, I think first what we're going to do, just take a quick recap in terms of when each particular standard is going to become applicable. So we're going to first introduce ourselves, rather, I would say, revise ourselves in terms of which permutations and combination, which standard becomes applicable. And for this purpose, I am going to give you a simple three-step model, which will help us to understand, revise, that in which permutation, combination, which standard is applicable. So this is the first initial introduction, and that is based on a three-step model. So I'm just putting this as an introduction. I'm just putting that as introduction to the entire set of consolidation standards. And for this, again, we are putting a three-step model. So at the background, in order to appreciate the three-step model, just keep one thing, simple thing in mind. Let's say company A acquires something from company B. So just keep that in mind, that there is a company A. So at the background, we'll take an example that there is a company A and it acquires something from company B. So we're going to put across some questions to A Limited, who can be technically called the acquirer. Though I think it is more appropriate to use that word once we establish the relationship. But I think still we can say A is the acquirer and B is supposed to be the acquiree. So we're putting the questions to A Limited. So the very first step, step number one, we're going to put a question to A Limited. What did the acquirer acquire? So the first question to be put across is, what did he actually acquire? So I would say the answer could be that he acquired an individual asset or he acquired a group of assets. Now, when you say a group of assets, it could be with or without liability. So though we use the word group of assets, but it can be with liabilities as well. So the first focus is to identify what did the acquirer acquire. So either we say he acquired an individual asset. Either we say he acquired an individual asset, or we can say he acquired a group of assets. And as clarified, this can be with or without liabilities. So that is implied. Now, when I say that he acquired an individual asset, one thing is very clear. It can never trigger consolidation standards. Acquiring an asset on a standalone basis can never trigger the consolidation standard. But when it says that it is acquired an individual asset, we can now still decide which standards would apply. So we will say, okay, did he acquire a tangible asset or did he acquire an intangible asset? So based on your previous inputs knowledge, would you like to tell me that if it is an tangible asset, which index would apply? And if it is intangible asset, then which index would apply? Just go back to the memory lane of the asset related standards and think that if it is a tangible asset acquired, then which particular standard will get triggered?
PP 16, sir.
16.
Wonderful indeed. It could be Index 16, that is a property, plant, equipment, or I can say it could be Index 40. I'm not looking at Index 2. It could be Index 2 as well, if it is a case of inventory, but I'm keeping it as non-current typically. So if he acquires a tangible non-current assets, it would be 16 PPE or Index 40, that is investment property. And if it is intangible, would you like to tell me which index would apply in that case?
38.
Wonderful indeed. So that's going to be index 38, but the consolidation standards in any case would not trigger. Made life simple, that means the focus point is what did you acquire? Now, if you say it is a group of assets, then we need to go to the step number 2. So that is the step number 1, just deciding what is being acquired. Let's go to the step number 2 and see the further inputs. So once we say that yes, he's acquired a group of assets, we go to the step number 2. And now the focus point is to decide that is this group of asset supposed to be a business or not? And there are certain tests which you already know are given in Index 103, which is business combination, which tells you helps you to decide is it a business or not. So one is what we call a concentration test, which is supposed to be an optional test in nature. The other one is what we call the 3-element test, which I call it as IPO, input process output test, which is mandatory in nature. And that would decide the fate whether it is a business or not. We'll make that summary chart of the test later. But let's say we identified by applying the test, we need to see is it a business or not. So the second step is to see that is the group of assets, because we said in step 1 that it is a group of assets. So is the group of assets a business or not? So is the group of assets a business or not? So the focus point is deciding that is the group of assets supposed to be a business or not? And just to, I think, document it out here, when you say that it is a business or not, we need to apply the test. So for this, we need to apply the test as per Ind AS 103. So we need to apply the tests which are prescribed in Index 103. And just to put it at the right place, we can say that one is called the concentration test. So we'll talk about this concentration test also. We'll do a quick revision on that because it can be very interesting inputs in the MCQs at least. And then there is a 3-element test, and which I call it as an IPO test. Of course, it is not called an IPO test. I just call it as an IPO test because the 3 elements are input, process, as well as output. So with the help of this test, we are able to zero down on the fact that the group of asset is supposed to be a business or not. And once you apply these tests, we reach a conclusion that yes, it is a business, or we reach a conclusion that no, it is not a business. Now, once you reach a conclusion that no, it is not a business, this means that consolidation standards again cannot trigger. But in this particular case, Index 103 has given us a guidance. Though the consolidation standards do not trigger, but Index 103 has given us a guidance that you need to basically, you paid a consolidated consideration. So that consolidated consideration is to be bifurcated between the individual assets acquired. So just divide the purchase consideration in the ratio of fair value. So you can say in this particular case, the purchase consideration is allocated. The purchase consideration is allocated to various assets. The purchase consideration is allocated to various assets in the ratio of, we can say, the fair value. So basically, the valuer would do the job and you tell him that I paid a consolidated consideration to acquire a group of assets. So he would simply divide the consideration paid in the ratio of fair value. And thereafter, once this allocation is done, you would again apply Ind AS 1640 if it is tangible, or Ind AS 38 if it is intangible in nature. But consolidation standards again would not trigger in this particular combination. And if you say yes, the group of asset is supposed to be a business, then it's time to go on to the step number 3, as simple and as straight. So I think the key focus points in terms of the first step is that you must acquire a group of assets. The focus in terms of step number 2 is the group of asset needs to be a business. If we need to reach the consolidation standards, acquiring more than one is important. And calling it as a business is important. And then comes the crucial step number 3. And then in terms of the step number 3, we need to put another question. And the focus is to decide that did you acquire a control over the group of assets? So what we're calling as a business, did we get a control over the business? So we will say that did A Limited, in my example A, did the acquirer. So A is the acquirer in my example. Did the acquirer get control over the business? So did the acquirer get a control over the business, which is the group of assets? So the keyword out here is control. Now, how do you assess a control is given in terms of Ind AS 110. And of course, we know that as per Ind AS 110, control is not supposed to be a rule-based assessment. It is not that you can say that you get more than 50% voting power in a company and you say that you get a control. Control is subjective and it is principle based as per 110 because you need to assess the concept of power. You need to look into that you are exposed to variable returns. And you need to prove that there is a linkage between the power and the exposure to variable returns as well. So, but for the time being, we can just consider that we are looking at a percentage somewhere that it should be more than 50% voting power. But I think I'm just going to put it across that when you're looking at the concept of control, so this is an assessment. This would require an assessment as per Ind AS 110. And this assessment as per Ind AS 110 will tell you whether the control is present or not. So the focus point 1 is group of asset. The focus number 2 is business. The focus number 3 is a control. When you prove the 3 elements, then only the consolidation standards would trigger. So you need to prove that you acquired more than a group of assets. You need to prove that it is supposed to be a business. And you need to prove that there is a control. Now here again, when you put the question that did we get the control over the business, the answer could be a yes or the answer could be a no. Now when the answer is supposed to be a yes, there will be a couple of standards which will trigger in this particular case. The company would start applying number 1, Ind AS 103, which is a one-time application. Ind AS 103 business combination applies only once when you acquire the control over the business of a acquiree company. And then every year, the company will make 2 financial statements. One is a separate financial statements, which guidance is given in Ind AS 27. And one is a consolidated financial statements, which guidance is given in Ind AS 110. So I would put it like this, that there will be 2 set of standards which would apply. I'll put it like this, there are 2 set of standards which would apply. One is a standard which has got a one-time application. And the other set of standards, I would say, is going to be applied every year end. They're going to be applied every year end, each year by year. So the standard which is going to apply only once, is supposed to be Ind AS 103, which is business combination. And that's what our starting point is going to be today. We are going to go through the concept of a business combination Ind AS 103. And then there are two standards to be applied every year. One is Ind AS 27, which is on a separate financial statements. And one is supposed to be Ind AS 110, which is supposed to be consolidated financial statements. Because every year, A Limited, in my example, being a parent, because he gets a control, he becomes a parent of the acquiree. So in this particular case, he would be preparing separate financial statements where the investment is recorded at a cost or a fair value. And every year, there is going to be a preparation of the consolidated financials as per Ind AS 110. Now, if you say no in this particular case, that no, we did not get a control in this particular case, we need to go through certain sequential questions. We need to go through certain sequential questions and put across certain questions. Okay, is there a joint control? If no, is there a significant influence? If no, then is there a passive investment? And these questions will be put across in a sequential manner. So in this particular case, we can say there will be certain sequential questions to be put across. We'll have to put across certain questions in a sequential order. And that is, first of all, we will say, okay, if there is no control, maybe there is a joint control. Two or more than two parties put together, two or more than two investors put together have got a joint control. And if not, if you say no, then in that particular case, we see, is there a significant influence? Which generally comes in when you get 20% or more than 20% voting power, but of course, up to 50%. And if you say no, there's not even a significant influence, then we say that is it a case of a passive investor? Then is it a case of a passive investor? So let's see that if you say yes, there is a joint control. If you say yes, there is a joint control, then two standards will trigger every year. So two standards will trigger every year. One is making a separate financial statements, that is Ind AS 27. Separate financial statements as per Ind AS 27. And one is going to be Ind AS 111, that is called joint arrangements. That is called joint arrangements, where the consolidation will take place depending upon whether it is a joint venture or is it supposed to be a joint operation. And accordingly, you would apply 111 or maybe 28. And if you say that no, it's not a significant influence, and I say yes, significant influence is present, then also two standards will trigger in this case every year. One is Ind AS 27, which is on the concept of separate financial statements, and one is Ind AS 28, which talks of consolidation with reference to associate and JVs. So if not a joint control, then a significant influence. So one thing is very clear, you need to assess the relationship of control, if not there, joint control, if not there, significant influence, if not there, passive investor. It is to be applied in a sequential order. And if you say no, it's not even a significant influence and it is a case of a passive investor, then in this particular case, there will be no consolidation. There will be no consolidation in this case. Consolidation happens only when you get a control or a joint control or a significant influence, and there is a passive investment which is generally a percentage below 20. In this particular case, we are supposed to apply only one standard, that is Ind AS 109, financial instruments. I think you would recall when we were covering the concept of financial instruments, I also made a mention that the chart on Ind AS 109, equity investments applies only to unrelated parties. I very clearly said that if there is a related party investments in those particular cases, we apply the concept of Ind AS 27. So when you're considering only unrelated party, and this becomes a case of an unrelated party investments, where we would apply the concept of Ind AS 109. So I think let me now just take a quick look at the three-step model consolidating which standards apply in which particular case. Let's go back and let's, I think, consolidate the picture. So I have given you the inputs in terms of first identifying which standards would trigger in which permutations and combination. Rather, I think it's a good idea asking some questions to you in between where you could help me in identifying the standard number. I think that's a better choice. So there are three focus points to begin with. You need to see that you acquired group of assets, not one, more than one. The second focus is it is supposed to be a business. And the third is that you get a control or a joint control or a significant influence in order to apply consolidation standards. Let's now put some rapid fire questions to you. When does Index 103 apply? Is there only one situation where Index 103 can apply? What do you say?
Yes, sir. Only one situation when the control is yes.
Wonderful indeed. So can I say Index 103 applies only when you establish a control and there is no other case where 103 would apply. And just to tell you, emphasize that Index 103 is a one-time application. It does not apply year by year. It only applies on the acquisition date. And that's a one-time application, that's all. Let's now give you some combinations. Tell me the standard numbers which would trigger. If you get a significant influence, which standards would trigger? Just the number.
So one Index 27 and 28.
Very good. If you say that there is a control, then which standards would trigger?
103 and 110.
And 27 as well.
37.
Yes, sir.
Okay, then let's look at the case where you are having no related party relationship. Which standards will trigger?
109.
Wonderful indeed. So I think that takes care of the good inputs. So I think we just made a very basic introduction in terms of which permutation combination with standards would apply. Now my next quick agenda of revisions with you is understanding the concentration test and understanding the three-element test. And then once we've understood this, then effectively we'll come to the concept of what is called acquisition accounting under Index 103. So let's, I think, first take a little recap in terms of the test to identify whether it is a business or not. So we are looking at whether the group of asset is supposed to be a business or not. So I think first let's take a quick look at the two tests, the interaction between the two tests, that which one is mandatory, which one is optional, and what permutation combinations apply. So as mentioned earlier, when you're looking at the concept of a business, it is number one called concentration test. As far as the concentration test is concerned, it is completely optional on the part of the company. The acquirer wants to conduct an optional concentration test or not is supposed to be a complete choice on his part. And then the second one is what is called the three-element test. And this is what I call it as IPO, because the three elements are supposed to be input, process, and output. And this test is supposed to be something we can say mandatory. It is something which is mandatory. But let's first look at the permutations and combinations which would trigger in this particular case. Now, since the concentration test is optional, the company says, yes, I am applying. Or the company says, no, I am not applying. If the company says, no, I am not applying, then you need to definitely apply the three-element test. But if the company says, yes, I am applying this test, the company says, yes, I'm applying the test, and you pass this test, or you fail this particular test. If you fail this particular test, then again, the three-element test becomes mandatory in nature. And if you pass the concentration test, then we have decided that it is not a business. Then we have decided that it is not a business. So this is the interaction in terms of the test to be conducted. So if you apply the optional concentration test and you pass it, we've reached a conclusion, it's not a business. If you apply the concentration test and you fail the test, then applying the three-element test becomes mandatory. And even if you choose not to apply the concentration test, then also the three-element test is mandatory. You want me to do a quick revision on the concentration test or directly take you to the question? What do you want me to do?
Division.
Okay. So I think let's now do a quick revision on the concept of a concentration test. So let's have a look in terms of what is the concept given in the concentration test as per 103. Well, you can say this was more like a litmus test where the standard setters wanted to make the life more easy for companies, where they could just identify whether it's a business or not. So I have divided the concentration test also in terms of three-step model. You're going to see a lot of three steps, maybe 7 steps as well, in terms of these consolidation standard. So I've divided this entire concentration test in terms of a three-step model again. So let's see what are we going to do in terms of the three-step model. So let's outline the 3 steps in this case. As far as the step number 1 is concerned, it's going to be divided in terms of 3 sub-steps. Go clearly step by step, and you'll never go wrong in terms of a calculation because you're concentrated in terms of each application of the step. So step number 1, we're going to divide in 3 parts. Step number 1A, step number 1B, and step number 1C. In terms of step number 1A, we are going to consider the sum total of 3 elements. We're going to add the sum total of 3 elements, the purchase consideration, if there is any previously held interest, and if there is any non-controlling interest. And let me keep reminding you the logics in this particular case as well. So you need to add 3 elements, the purchase consideration, the previously held interest, as well as the concept of non-controlling interest as well. Now, why do we add all these 3? Let's say, for example, the acquirer A already has got, let's say, a 10% stake in the acquiree. So we can say the previously held interest is, let's say, to the extent of 10%. And let's say now he is acquired, let's say, another 70%. It is supposed to be, you can say, a control achieved by stages. You can say it is a step-by-step acquisition where you already had a 10% stake, that's called a previously held interest, and you acquired another 70%, that makes it 80. So there is another 20% which is held by the outsiders called the non-controlling interest, and that makes it a total of 20. Can I say in this particular case, what is technically happening, when you add all these 3 elements, you are going to get 100% consideration. So your first focus point in terms of step number 1A is to add up the 3 elements, the consideration which is paid now, the previously held interest, and the NCI, making the sum total to be 100%. Then we go on to the step number B. Before I go to the step number 1B, let me also tell you that once you add up these 3 elements, is this the consideration which is paid for the net assets? Or is this the consideration which is paid for the assets? When you add these 3 elements, is this the consideration paid for the net assets of the acquiree, or is it paid for the assets of the acquiree? That's a question. So are you going to call this as a purchase consideration paid for the net assets or for the assets? I think I'll have to answer that question indeed. This is paid for the net assets. Because when you look at the purchase consideration, you paid the purchase consideration to get a control over the group of net assets of the business. So this is a consideration paid for the assets. So the next agenda in terms of the step number 1B is converting this converting this in terms of what is paid for the assets. What is paid for the assets? So what we're going to do, whatever value you've derived in step number 1A, you are going to add back the liabilities to this. Because I want to convert the purchase consideration which is paid towards the assets of the company. So what we do, you have got the consideration paid towards net assets at the liability. You get the consideration paid towards the assets. Now, this assets could also include certain notional assets like a deferred tax asset. This asset could also include a cash element as well, which needs to be eliminated because I need to see what is acquired, what is paid for the assets other than cash, for the assets which is other than notional assets. So in this particular case, whatever answer you get from 1B, we are also going to eliminate the cash acquired. We are also going to eliminate the deferred tax assets, if any. And this will indirectly give you that what is paid for the assets other than. What is paid for the assets other than cash, and you can say notional assets. So what is paid for assets other than cash and the notional assets in nature, because DTA is supposed to be notional in nature. So the very idea in terms of step number 1A, B, C in a chronological order is converting it slowly and steadily. First, you add the three elements to get what is paid for the net assets in entirety. Add the liabilities to get what is paid for the assets. Reduce the cash and the DTA so that we get what is paid for all assets other than cash and notional in nature. I hope, friends, you got the picture clear. Step 1 ABC. Because I didn't get much inputs at your end, I hope you connected the dots, right?
Yes, sir.
Wonderful. And then we go to the step number 2. In terms of the step number 2, now you need to identify that single asset, or maybe you can say a group of similar assets. You need to acquire a single asset or a group of similar assets. So you need to see that it could be a single asset or a group of similar assets, which I would say has got the highest fair value. So I would say identify that asset or a group of asset which seems to be having the highest fair value of that particular asset. And then what I am going to do in step number 3, I will take the value as per step number 2, divide this by the value as per step number 1, convert this into a percentage. Basically what we are doing, we are considering that, okay, this is the fair value of that asset. So you say that one asset is, let's say, 90 crores. And let's say the answer as per 1C is, let's say, to the extent of 100 crores. So we can say 90 crores effectively is paid just for a single asset. Out of the total 100 crores paid for all the assets, you paid almost a substantial amount towards that one asset. So in this particular case, if this percentage is substantial, though nowhere we've been defined in the standard what is a substantial percentage, but generally we can say if it is 90% or more, we could say that it is a substantial percentage. So if you see that the percentage is 90 or more, I'm not going to document that 90 because that is subjective. So if it is supposed to be a substantial percentage, then we can say the test has got passed. And if the test is got passed, then we can say it is not a business. If the percentage is not substantial, the test fails, and then you need to conduct the 3-element test in this case. So let's get the dots connected before we take you to the practical illustration on this. So go in a chronological order in terms of the concentration test. You need to first add the 3 elements. And remember, at the back of the mind, by adding these 3 elements, you are able to say, okay, this is paid for the net assets of the equity. But the idea is to convert what is paid for the assets other than cash and notional assets. So next stage, you add the liabilities to convert it what is paid for the assets. Next stage is to eliminate the cash acquired and the notional assets to understand what is paid only for the assets other than cash and notional. Then identify the single or the group of similar assets which has got a highest fair value. And then take the percentage of the figure in step number 2 as a percentage of 1. If it is almost more than 90, the test is pass, not a business. And if it is below 90, the test fails, and then we need to apply the 3-element test in that case. Right, friends, I hope I am clear with the picture. So I hope we are clear with the 3-step model in this case. Correct?
Yes, sir.
Wonderful indeed. So I think now we can take you to a small little question. I am just going to show you a question which is there in the study material itself. So I'm just sharing a question to you on the screen. I'll share that on the laptop screen, not carrying it on the board at the moment. So we'll first read the inputs and then we'll decide the fate of the concentration test. Okay, let me just share that on the screen to you. I hope the question is visible, right?
Yes, sir.
Wonderful. So let me just read the inputs and you're going to help me in applying the 3-step model to understand the concentration test. It says entity A holds a 20% interest in B. Subsequently, A further acquires a 50% share in B by paying 300 crores. What is this 20%?
It is a pre-holding.
That's right.
holding.
Can I call it as a PHI? That is a
PHI.
previously held interest. Correct. And then they acquired another 50%, making it 20 plus 50, 70. So can I outrightly say that there is a 30% NCI? Yes, of course.
Yes, sir. 50 plus.
And that's absolutely correct. Then we are also given the fair value of the assets and liabilities acquired. Can you tell me which is supposed to be a liability which should be added back in terms of step number 1B?
Financial liability.
That's right. And DDL?
We have to
Yes,
reduce
that's
it.
also notional in nature. We'll add
We
it
have-
back. And which is the assets which you are going to subtract in terms of step number 1C? Sorry, you'll subtract, yes, as per step 1C.
It's a TTL.
That's right. So, sorry, cash and cash equivalents, not DTL. Step 1C would be assets. So we'll reduce the cash and cash equivalents. Then he says the fair value of the entity as a whole is 400 crores and the fair value of the NCI is already worked out to me. 30% of 400, that's 120 crores. Then he says the fair value of A's PHI is also given, that is 400 crores into 20%. Entity A needs to determine whether the asset is an asset acquisition or as per the concentration test. Okay, so I think that's pretty simple. If you've understood the 3-step model on the revision, then I think one can simply do this question very easily. So let me just organize the input in this case. So I think let me just organize the data. So I am looking at the concentration test. So in terms of the concentration test, step number 1A, step number 1B, and step number 1C. So let's add the purchase consideration plus the PHI and plus the NCI. So as far as the purchase consideration is concerned, just to remind the figures to you, the purchase consideration is given. We paid a total of 300 crores. So we paid a total of 300 crores as a PC. We need to consider the PHI and the NCI at a fair value, not what is paid originally. So I am given, as far as the PHI is concerned, it is supposed to be 80 crores. The fair value of the PHI is 80 crores. And I'm also given the NCI, the fair value of the NCI is supposed to be 120 crores. So let's add these figures up and see what is the sum total of 100% of the consideration. I guess comes to 500 crores.
Yes, sir.
That's right. And then we go to the step number 1B. Now, Can you tell me which is the asset which seems to got the highest value in this particular case? Oh, sorry, I first took the A point, first the B point as well. So on this 500 crores, let me just also adjust the liabilities. So can I say I'm going to add the financial liabilities and the DTL? So that's going to be 800 crores. And as far as the deferred tax liability is concerned, that is 150 crores. I think there has been a little difference in terms of your opinion, because if you look at the question which is done in the study material, I guess the adjustments of the deferred tax liability is not been done. So I think I'm also not taking that. Though I think this seems to be a little, maybe a difference in opinion in terms of things. I'm not adjusting that. So this works out at 1300 crores. And then we come to the step number 1C. So what is to be subtracted out of this 1300 crores in terms of 1C?
Cash and cash equivalent and DTA.
That's right. 200 crores is the cash equivalents. DTA is not given, so nothing to be adjusted. So this works out at 1100 crores. So this takes it to the step number 1, ABC, where we've indirectly got what is paid for the assets other than cash and notional. Now the next is we go to the step number 2. So can you identify what is the asset which has got the highest fair value in this particular case?
Yeah, show me the question, sir.
Oh,
Building,
yes, sorry. I'll
building, I
just show
think
the
so.
question back again.
I think building
So-
has 1000 crore, I believe.
That's absolutely correct. So we have got the business building in the question, which is supposed to be a total of 1000 crores. So the asset which has got the highest fair value is supposed to be 1000 crores. I guess now I can remove the screen.
Yes, sir. Now
That's
it's pretty easy that step number 1 divided by step number.
yes. So we're going to take 2 by 1. So
Yeah,
can
2
I
by
say
1.
1000 crores is the value of the building divided by 1100 crores? That is what is in step number 1C. Let's see what is the percentage.
90 point 90.910. 90.
95.9.
No. 90 percentage
Okay.
0.91.
So 91 effectively.
Yes, sir.
Okay. So approximately comes to 91%. So this 91% indicates that the concentration test is passed. So can I conclude it's not a business? It's an asset acquisition. It is not a business. It becomes a case of an asset acquisition in this case. So this could be, something small kind of, part of the case study questions in the MCQ, because I've not seen a larger question in terms of the 70 mark subjective questions, these kind of things coming in. But one can definitely expect something in the case study where you're given some inputs and you're applying the concentration test. So my concentration test is done. Then comes the concept of the 3-element test. So let's take you further. And let's do a quick revision on the concept of the next test, which is called the 3-element test. So it is called a 3-element test because of the 3 elements, and therefore I call it as an IPO test, because the 3 elements are I, that is inputs, then P, that is process, and O, that is supposed to be output, and therefore it is called a 3-element test: input, process, as well as output. So we'll take a quick revision in terms of understanding this 3-element test as well, though I am not planning to take any case studies on that because this can be subjective as well. And I don't recall that there have been questions in the exam explicitly testing you on the 3-element test. So here again, to make your life simple, I have again converted this into 3-step model. Since morning, I have given you 3-step models thrice. One is I gave you on the introduction part a 3-step model, then on the concentration test a 3-step model, and now on the IPO another 3-step model. So let's consider how do we apply this 3-element test, converting this again into a 3-step model.
Sir, sorry to say this, but I am remembering your name as a three-step model.
That's perfectly okay. Okay, so let's, I think, go forward to this. And this is step one. I'm sure, next time we personally meet, then you're going to remember me. This man is the three-step model man.
Yeah, definitely, sir. There is a time shortly.
That's wonderful. Okay, so coming back to the input on the three element test, that is input, process, output. So let me, I think, first tell you, just to remind you that when you're looking at the input, process, output, input is more like a raw material and the output is more like a finished goods. And the input, that is a raw material, is to be converted in terms of finished goods, and that exercise is done by a particular process. So let me also tell you, when you look at a process, it could be a formula or it could also be an organized workforce, because those people have got the necessary skill and knowledge with which the input is going to be converted into output. So the organized workforce, the formulas, they're all supposed to be a part of the process. So first of all, in step one, we will only ask ourselves a question: that did we acquire? We just need to understand that did we acquire both input and process, not the output. So we need to only put across a question that did we acquire both input as well as the process. The focus in step one is not on the output. We need to focus only in terms of the input and the process. So if you say a yes, we'll go to step number two. And if you say a no, then we can say in this particular case, it is not a business. It is an asset acquisition in this case. Because if you're acquiring, let's say, input without any process, then it cannot be a business. It is supposed to be an asset acquisition. So wherever I say it's not a business, it would be implied that it is an asset acquisition. And if you say a yes, then we need to go to the step number two in this particular case. So your first focus would be to identify that are we acquiring both the inputs and the process. Both elements need to be acquired. And then we go on to the step number two, which is again pretty simple and straight indeed. Now the focus is on looking at whether there is an output or not. The day you acquired the acquiring company, was the output present or not? And the output presence is indicated by the presence of revenue. If the revenue is present, we can say output is there. If the revenue is not present, that means there is no output. So indirectly, you can focus on the presence or the absence of a revenue. So we need to see that is output present? Is output present on date of acquisition? Or we can say on acquisition date. So the focus now is in terms of output. So is the output present on the acquisition date? So in this particular case, the answer could be either a yes or the answer could be a no. Irrespective, we will go to step number three. So irrespective whether you say the answer is a yes or no, we're going to go to step three. So the idea is only to identify the output is there or not, nothing else. And as I said, when you're looking at the output, you can say the revenue, the presence of the revenue is the indicative factor. If the company is generating revenue, that means the output is present. If not, the output is not present. Then comes the crucial step, that is the step number three. Then comes the crucial step, which is the step number three, wherein we are just going to make a chart. Because we've seen that the output is there or the output is not there. So we will consider whether the output is there. So we can say one case is that the output is there. The other case is that the output is not there. So we've got two combinations, that the output is present or the output is not present. Now, I would say that if the output is present, you need to meet any one of the two, you can say, categories of conditions. If the output is present, you need to prove in one of the two categories of conditions. So I'm just putting the crucial words out here. So the first set of condition is that the process is critical. You need to say that the process is critical in nature. So once we're able to prove that the process is critical, and we also need to prove the second condition, that we have taken over the organized workforce. Along with the other elements of input, we've also taken the organized workforce, the people who have got the necessary skills as well as the experience with which we can decide. The necessary skills and conditions with which we can decide that yes, you've taken the process. So prove the first set of conditions. If no, you can prove the second set of conditions as well. And the second set of condition is that we need to prove that the process is supposed to be unique or scarce. The process is unique or scarce in nature. So the process is something which is unique or something which is scarce in nature. And you also need to, and I think that's the only condition effectively, not a second condition. This is the only condition, that it is unique and scarce. And we can just add maybe that it cannot be replaced. It cannot be replaced without any incurrence of a cost, without a substantial incurrence of a cost. We would not be able to replace this particular process. So meet either these two conditions or meet either these two conditions, and that would explain the inputs. And if the output is not present, you need to basically meet a total of three conditions. Prove that the process is critical in nature. So prove that the process is critical, which is the same note which is there, a condition which is there here as well. The second is we need to consider that we've also acquired organized workforce. So consider that we have also acquired an organized workforce, which is also the same condition appearing here as well. And the third condition is that we need to consider that we also acquired other inputs. We also need to consider that we acquired other inputs as well. So you can say here it is meeting one of the two set of conditions, and here it is meeting the three conditions. So you can see that once the output is not there, you can remember the condition gets a little more stringent. So if the output is not there, we've got a total of three conditions to meet. But if the output is present, then we've got only two set of conditions to be met effectively. So you can say that if there is an output less stringent, two conditions. If there is no output more stringent, you've got three conditions to meet. Right, friends. So I think that takes a quick recap in terms of the decision as far as the business is concerned. So now we can just, I think, connect all the dots put together. Step number one, when I gave you the introduction, we said you acquired a group of assets. Step number two, I said it's a business or not. Now we know the concentration test also. Now we know the three-element test also, which will help us to decide a business or not. And then the third step is in terms of the permutation combinations, control, joint control, single influence, passive investment, which permutation combinations, which standards would trigger. I think that takes care of our first phase of discussions. I hope we are clear till this stage. I can now take the journey to the next part of the standard. I presume the silence to be a yes.
So in this case, if both either in step 3, either the conditions are satisfied, or if the output is not there, the three conditions are satisfied, then we conclude that it is a business.
It's a business. Yes. I didn't make a mention on that. So once you're able to prove these conditions, then we can say yes, it is a business in that case, if the conditions are met. And if it fails, then it is an asset acquisition in that case. Correct. Okay, so now I think let's go to the next phase of discussion, which is the most crucial part of the discussion. Now you got a choice, since this is more like a revision and concept revisions and a practice. Now, what do you want me to do? You want me to go give you practice questions in each step of discussions, or you want me to do, first give you the entire 7 step, because I'm going to divide the concept of acquisition accounting based on a 7 step model. So you want me to practice questions step by step as we discuss, or you want me to do the practice at the end? You've got a choice. Yes, I think Saminath, you have raised your hand. Yes, please go ahead.
Yes, sir. On the initial, the second step is the group of asset business group or not. When there is no, then we will do the concentration test and the 3 element test.
You're talking about the main step which I gave you, step number two?
Yeah. Main step.
Yeah.
Yeah, I'm talking about this.
So you said that if it is not a business, then
Okay, this the 3 step, the concentration and the 3 element test, when it is coming.
okay. You see, when you are deciding that the group of asset is a business or not, apply these tests. So once you've decided that you've applied these tests, then you reach a conclusion: yes, it is a business; no, it is not a business. So the decision of this yes and no depends upon these tests.
Okay, on the step number 2 itself, we need to do the concentration and the 3 element test.
Yes. That's why I discussed that later. Okay, let me just connect the dots once again. I did the introduction, and then after the introduction, I discussed the concentration and the IPO test. The concentration IPO test is applicable to the step number 2 of my main step.
Right, sir.
Yes, so when you go to apply the step number 2, in order to take a decision whether the group of asset is a business or not, you apply the concentration test, you apply the IPO test, reach a conclusion: is it a business or not? If you say no, then the 103, nothing applies, just segregate the fair value ratios. And if you say yes, then you go to the step number 3 to see the control factor, joint control, etc. Right.
Right, sir. Clear, sir. Just I recalled it. Yeah.
Okay, wonderful indeed. So I think, what do you want me, friends, to do? Do the questions simultaneously on each steps, or you want me to do the questions in the end? Because I'm going to divide the entire process of accounting in 103 into a 7-step model. So you want me to do the questions practice, because there are some questions, some kind of questions which are pertinent to a particular step itself. So you want me to do the practice there and then, or towards the end?
Sir, we will do as soon as complete that steps.
Okay, so we'll do it simultaneously. Wonderful indeed. Okay, so let's, I think, now begin the concept. So first, I think I like to broadly divide the accounting in 2 parts. I think this is one of the very crucial steps which I am discussing. Not exactly a step, but just to give you a basic, inputs on that. Today, my AC is also given a little way. I think it's in a bad mood on a Sunday. I'm making it work on a Sunday, so it's not really working, getting hot. Anyway, I think that will get rectified. Okay, so let me, I think, first of all, start with the basic exercise to you. So if somebody were to tell me that please capture the accounting under Ind AS 103 in a crux manner, I would say, okay, let's answer one question. Is the transaction between related and unrelated parties? Mind this carefully, because this is a very crucial chart. Because when you go to do the bigger questions, on practice, I think this is one thing which should, come at the very start when you kick off the question. So I would say, okay, let's decide, is the transactions between unrelated party, or is the transaction between related party?
So this is a transaction between the related parties. If it is unrelated parties, it will go to Ind AS 109.
No. I'm not talking about that. No. Just you'll get the answer. I'm looking at A and B dealing with each other, where A says, I want to acquire a group of assets which is classified as a business and there is a control. So now we are saying once you've applied the three steps, that you've established that yes, a business combination standard will trigger, then comes the stage of deciding that this transaction of a business combination is between related, unrelated party. If it is between related party, then the guidance which is given for common control transactions may apply. I am not saying that the common control transactions will definitely apply. Mind the words. I'm saying the common control, you can say the common control guidance will generally apply. Because there are good chances that if it is a related party transaction, then we can say the common control guidance would apply. And this common control guidance is given in the Appendix C of Ind AS 103. So this is going to be the application of, you can say, Appendix C. This is an application of Appendix C to Ind AS 103. So we need to see that, for example, A is the parent already, and B is the subsidiary already, and C is the subsidiary already. Now, there are transactions happening between A and C, for example. So in this particular case, when you see that transaction is between a related party, then the chances are bright that it would be covered under a common control transaction. Appendix C, Ind AS 103. Next. If you consider that it is supposed to be an unrelated party transactions, then we can say either we will land up applying what is called acquisition accounting, or we will land up applying what is called a reverse acquisition. What is called a reverse acquisition accounting. Because basically there are three kinds of accountings which are given in Ind AS 103. I want to make the focus clear. There are basically three kinds of accountings which are given in Ind AS 103. One is called acquisition accounting, one is called a reverse acquisition accounting, and one is called the common control transactions. So we are filtering that generally if there are transactions between related party, then the common control transaction guidance Appendix C would apply. But if it is unrelated party transactions, one of the two would apply. Now, which one would apply is what we're going to see later. But this reverse acquisition accounting is, again, the guidance is given in terms of Appendix B to Ind AS 103. So this is given in Appendix B, Ind AS 103. And as far as the acquisition accounting is concerned, this is given in the main part of the standard. The main part of the standard contains the acquisition accounting in this particular case. So, moral of the story. So I'm just trying to filter that there are three kinds of accounting. One is called acquisition accounting, one is called a reverse acquisition accounting, and one is called a common control transaction. We're just trying to filter that when you read a question, you need to be careful that the transaction is happening between already existing related parties. The chances are bright that it would be a case of Appendix C. But if the transaction is happening between unrelated parties, then the transaction definitely is not Appendix C, but one of the two. Which one of the two? That's what we're going to identify. I hope I made the picture clear. Not in terms of, what you were saying. I hope you got the point clear, right?
Yeah, I got it clear, sir. Because the business acquisition can be from the unrelated party as well as the related party. Obviously.
Correct. Yes.
Yeah.
So
In
now
case of,
I am...
yeah,
Yes,
I confused because it is a passive income. When there is a significant influence is not there, which means those cases the 109 will apply.
Correct. So right now we are saying that, the control is established. So we are within 103. So within 103, now there are three kinds of accountings which will trigger.
Yes,
So
sir.
we're now going to discuss.
Yes,
First, we're going to concentrate on acquisition accounting. Then we'll go to the reverse acquisition. Then we'll go to the common control and proceed. So my focus right now is just on the acquisition accounting.
yes, sir.
So
Perfect,
to make life simple, as far as the concept of acquisition accounting is concerned, I have divided the entire acquisition accounting into a 7-step model. Can't contain it in a 3-step model. So we've converted this into a 7-step model. So let me now introduce you that what are these particular 7 steps which would trigger in this particular case. So first of all, let me lay down that what are the 7 steps which would apply. Step number 1, we need to identify the date of acquisition. The first step is to identify the date of acquisition, and that can never be a challenge. I will not get into the nitty-gritties. That could not be a challenge, at least for a larger question, because date of acquisition would be very explicitly given in the question, because this is the date when you acquire a control over the acquiree. So date of acquisition is typically, of course, the date when the acquirer gets a control. So when the acquirer gets a control, so that is the date of acquisition when the acquirer gets a control. So that would not be a challenge at all, getting the date of acquisition. So we're not going to discuss or do any questions on this particular issue. Though if you want to see more questions on this area, you can watch the detailed lectures where I have covered the aspects of the case studies on the first step as well. Then we go on to the step number 2. And in terms of the step number 2, we need to identify what we call the accounting acquirer. We need to identify what is called the accounting acquirer, not the legal acquirer, but we need to identify the accounting acquirer. And it is this step which will help you to decide that whether acquisition accounting or a reverse acquisition would apply. So this is a very crucial step, because once a transaction is happening between the unrelated parties, this step will tell you that acquisition accounting would apply or a reverse acquisition would apply. So we'll discuss that. The step number 3 is creating a list of net assets. The third step is creating a list of net assets which are acquired by the company. So we need to basically get a list of all the net assets which are acquired by the acquirer company. Because once we need to do an acquisition accounting, it is important to identify that which assets and liabilities have been acquired. So that's going to be step number 3. Then in terms of step number 4, we will organize the calculation of purchase consideration. We will organize the input in terms of purchase consideration, that is PC. What is the consideration which the acquirer paid to the shareholders of the acquiring company? So that is the purchase consideration. You can definitely get independent questions on the step number 4. There can be independent questions. There have been questions in the past in the exams just on the concept of calculating a purchase consideration. Then the step number 5 is to calculate the NCI, that is non-controlling interest. That is non-controlling interest. So you can get maybe a small question within the MCQs as well, if not independently, that you are required to calculate the NCI, the non-controlling interest. Then the next step is the step number 6, which is calculating the goodwill. Or you can say the capital reserve, what we call the bargain purchase gain. So this is calculating the goodwill or the capital reserve, which is the bargain purchase gain. And the step number 7 is organizing all this information into a single acquisition entry. So let's see what is the step number 7. The step number 7 is basically passing the accounting entry. The step number 7 is basically passing the acquisition entry, and that acquisition entry is in terms of what we call acquisition accounting. This is called acquisition accounting. Organizing all the informations, organizing all the 6 steps into a single entry, that's the main focus. So this entry would be passed in the books of accounting acquirer. This entry is going to be passed in the books of the accounting acquirer. That is focus 1. And this entry will be done on date of acquisition. So we're going to do this entry in the books of the accounting acquirer, and this entry is going to be recorded on the acquisition date. So what is the entry? The entry which we're going to pass in this particular case is net assets. the net assets will be given a debit, and then we will consider the purchase consideration gets a credit, the NCI gets a credit, and we generally get a goodwill as a balancing figure in this entry. So this is how the journal entry will look like broadly. The net asset gets a debit, the consideration and the NCI gets a credit, and the goodwill generally is a balancing figure on the debit side. But trust me, I have organized all the 6 steps in order to pass this entry itself. See what? If you correlate, can I say the date of acquisition is identified in step number 1. You've already identified the date of acquisition in step number 1 because I need to know when do you pass this entry. The books of the acquirer, you've already identified the accounting acquirer in terms of the step number 2, that who is the accounting acquirer. Then I organize the list of the net assets in terms of the step number 3. Then I've organized the purchase consideration in terms of the step number 4. Then I'll organize the NCI in terms of step number 5. And I've already organized the goodwill also in step number 6. And all the steps put together basically becomes the step number 7. So go chronological order so that you never ever go wrong. You need to basically work towards this entry. And in order to work this entry, you can say the first 6 steps is like working notes to the question. This becomes the main solution where you're seeing that this entry is done on which date, is done in whose books of accounts, and then organize the elements. I hope, friends, you got my thought processes clear that the focus is to organize which date, which books, and then organize the entry in the books of the accounting acquirer. Focus is on the net assets. Focus is on the consideration. Focus is on the NCI. The focus is on the goodwill. Right? I hope the thoughts are clear.
Yes, sir. Crystal clear.
Wonderful indeed. So now what we are going to do, we are going to go step by step. And as we decided, we are going to do steps and then we'll do the relevant questions along with each step. And then later we'll practice the bigger questions also with you. So first of all, I guess in terms of step 1, as I said, there is going to be no challenge. So I am not discussing step 1. I'm going to directly decide the inputs in terms of step number 2. Which will also give us an input. How do you decide it is a case of a reverse acquisition or a case of acquisition accounting? So let me make a interesting summary chart. In terms of step number 2, this is identifying the accounting acquirer. This is identifying the accounting acquirer. So I'm just going to give you a simple summary chart that will contain all the elements deciding how do you decide who is the accounting acquirer. So first of all, there will be certain focus points which we'll see automatically built into this particular chart. So let me create the structure. Your first focus point is to see that was a new company created for the acquisition or not. So your first focus point would be to see that for the purpose of acquisition, is the deal between 2 existing companies or did you create a new company for the purpose of the deal? So either a new company is not created or a new company is created. So that's going to be the first focus point. Don't worry, we'll see a practice question also after the concept is revised. So I'm going to see whether a new company is not created or a new company is created. Now, if you say a new company is not created, or if you say a new company is created, there are 2 further permutations and combination. You need to see that the purchase consideration is mainly either in cash or the purchase consideration is mainly in terms of shares. So you need to basically see that the consideration is mainly in which form of payment. Is it mainly in cash or is it mainly in shares? I'm not saying it's only, I'm saying it's mainly. That means major component of the consideration is in cash or shares. Here also we'll look into the combination. The purchase consideration is mainly in cash, or we can say the purchase consideration is mainly in shares. It's mainly in cash or it is mainly in shares. Now, I think let's take a little example so that we can understand this better. So let's consider that there is a company A and there is a company B, and both these companies are existing company. I'm just going to give you an input so you can decide logically and decide. So there is a company A and there is a company B, both are existing companies. No new company is taken, created. A would approach the shareholders of B and pay them cash. A would approach the shareholders of B and pay them cash. Does the shareholder of B become the shareholders of A? Of course not. Because the consideration is paid in terms of cash, so to the shareholders of B, you are making a payment in cash and not in terms of shares. So in this particular case, we can outrightly say that in this case, the legal acquirer and the accounting acquirer will always be the same. And this would mean that we are applying acquisition accounting. Because when the consideration is paid in terms of cash, we can outrightly say one thing very clear, that if the consideration is paid in terms of cash, then the shareholders of the company B Limited are not becoming the shareholders of company A. If they're not becoming the shareholders of company A will still always be in control of his own company. So it can never be a case of reverse acquisition. But let's imagine if company A issues shares to the company shareholders of company B. So if the consideration is mainly in terms of shares, that means A is telling the shareholders of B, I'll give you shares in my company. That means I am diluting my stake in my own company. So for example, if company A is got 100 shares and company B is got 60 shares, and you tell the shareholders of B, I'll give you 1 share for every 1 share. So would you like to tell me that after A gives 60 shares to B shareholders, how many shares will A have? He's got 100 shares and he gives to the
160.
shareholders B another 60 shares.
40.
No. He's not
Totally
going to get
160.
out of this 100. 160 new shares will be given.
160. 160.
So can I say now the stake of A Limited shareholders is they've got 100 shares out of 160 shares, which means he's got a 62.5% stake in the company.
Yes, sir.
So even after A gives the shares to the shareholders of B, his stake gets diluted, but he's still under the control of his company. He's still got more than 50%. The percentage gets diluted, but he's still in control of the company. But let's imagine if the ratio of exchange is, let's say, 2.5:1. Same number of shares we're taking, but let's say A tells the shareholders of B, I'll give you 2.5 shares for every one. That means he's willing to pay 150 shares to the shareholders of B. If he gives 150 shares, can I say what will be the total capital base of A?
150 plus 100, 250 will come.
That's right. So the total number of shares in this case will become 250. So A Limited gets a stake only to the extent of 40%. He loses control over his own company. So one thing is pretty logical. If
Yes.
A Limited is going to give shares to the shareholders of B, he may give the shares in such a way that he loses the control. Or he may give the shares in such a way that the control is still there. The percentage dilutes, but the control is not gone. So everything is dependent upon the exchange ratio. Everything is dependent upon the exchange ratio, that A gives the shares to B in what ratio? In such a way that the control is diluted, but the control is not gone. Or in such a way that the control is diluted and is gone. So you need to be careful. You need to calculate the percentage pre-business combination and the percentage post-business combination. So in this particular case, when the consideration is mainly paid in shares, you need to consider what is the percentage pre-business combination, what is the percentage post-business combination. The comparison of the percentage will tell you. So this can be a case. It may be acquisition accounting. It may be a reverse acquisition. In this example, it is a case of acquisition accounting. But in that particular case, it becomes a reverse acquisition because A, who is a legal acquirer, becomes an accounting acquiree. B, who is a legal acquiree, becomes an accounting acquirer because A, on the papers legally, is the acquirer. But he gave the shares to the shareholders of B in such a way that he lost a control of the company. So from the accounting point of view, he is not the acquirer. He becomes an acquiree in that case. So this can be a case of acquisition accounting, or it may be a case of reverse acquisition accounting. Right? I hope you got the picture very clear on that. That if the consideration is shares, the pre and the post business combination percentages comparison will tell me whether it is a case of acquisition or a reverse acquisition. Correct? Now let's go further. And now let's consider that a new company is created. So let's say, for example, there is a company A Limited, and let's say there is a company B Limited. These existing companies are there, and a new company C is created. So we've got two existing companies, A and B, and we create a new company, C Limited, to take over the business. Now, if C gives a consideration to the shareholders of A and B in cash, shareholders of A and B will not become the shareholders of C. Because if C is giving cash to the shareholders of A and B, then shareholders of A and B will not become the shareholders of C. So in this particular case, if the consideration is given in cash, we can say that the legal and accounting acquirer will always be the same. So this will always be a case of acquisition accounting for sure. Because there is going to be no dilution of control because you are not giving them shares in your own company. But imagine if C Limited gives shares to A and B. C gives, let's say, out of 1,000 shares, 600 shares to A, and out of 1,000 shares, 400 shares to B. So can I say whosoever gets a majority shares in C gets a control over C? Because out of 1,000 shares, if A is given, the shareholders of A is given 600 shares, A gets a 60% stake. And B gets, shareholders of B get a 40% stake. So I can say outrightly, one of the two gets a majority, or maybe both gets a majority put together. So one thing is very clear, either A will get a control over C, or B will get a control over C, or maybe A and B collectively will get a control over C. So this will always be a case of reverse acquisition. So I would say this will always be a reverse acquisition in this particular case. So let me now connect the dots once again, because these are the four permutation combinations. You'll never get any fifth permutation combination indeed. So let's see the focus point. If the consideration is mainly in terms of cash, I don't care whether a new company is created or not. Mind the words. If the consideration is mainly in cash, I'm not concerned whether a new company is not created or a new company is created. I would say it is always going to be acquisition accounting. And the logic is simple, that as an acquirer, if I am going to pay cash to the shareholders of the acquiree, they do not get any shares in my company. So in this particular case, if the consideration is in cash, forget about everything else. New company created or not, undoubtedly it's a case of acquisition accounting. Second, if you notice in the question that the consideration is paid in shares, get into the point, is a new company created or not? If the consideration is mainly in shares and a new company is not created, you need to calculate the pre and the post business combination percentages. And once you calculate the pre and post business combination percentages, that would lead to the situation. It may be acquisition accounting, it may be a reverse acquisition. And if a new company is been created, undoubtedly it is a case of reverse acquisition. So your focus points will be, first of all, see the consideration is in cash. If yes, acquisition accounting. If the consideration is in shares, see new company created or not. If the new company is created, reverse acquisition. If the new company is not created, compare the percentages, pre-post business combination, and then decide. Right, friends, I hope I'm clear with the agenda of my step number 2, permutations, combinations, I guess.
Yes.
Yes, sir.
So let's, I think, give you a question on this. I'm going to share a question and we're going to apply the inputs on that step by step. So let's first give you a very simple little question and we can decide the agenda. I'm sharing that question to you on the screen. It is a question from the study material. So let me just share that question on the screen and then we'll apply this funda to identify the acquirer. So let's have a look at this question. It says ABC incorporated a company super. I hope you've got the point at the very start itself. The company super is incorporated. Is a new company created or not? It says ABC incorporated a company super. Is a new company
Yes,
created
sir.
for the purpose of acquisition or not?
Yes, sir.
Yes, it is created. So my mind is now working on the right hand side of the chart. It says to acquire 100% shares of another entity, Focus Limited, and therefore to obtain a control of Focus. To fund the purchase, Super acquired a loan from XYZ at commercial interest rate. In order to get the money for acquiring the shares in Focus, this company took a bank loan. Then he says the loan funds are used by Super to acquire the entire shares of Focus at a fair value. So is the consideration being given in terms of shares or cash? He took a loan and then with the loan money, he acquired the shares in Focus. So is the consideration paid in cash or is it mainly paid in shares?
Cash, sir.
Where does the shares come in? He
Cash,
took a
cash, sir.
loan. It's cash. I heard shares. Okay, so it is paid in cash. So can I outrightly say that in this case, it cannot be a reverse acquisition without even reading further?
Yes, sir.
Undoubtedly, yes. So he says the loan funds are used by Super to acquire entire shares of Focus at a fair value. Post the acquisition, Super has got the ability to elect or appoint or remove a majority of the members of the governing body of Focus. Now, you already know one thing, that the control is assessed by Indes 110, and he's telling me that Super is in the position to elect and appoint the key MP of the company. And also Super Limited's management is in a power where it will be dominate the management of Focus. So can Super be identified as the acquirer in the business combination? What do you say? So we've already seen the consideration is paid in cash and a new company is created, which means the legal and the accounting acquirer is same. And he's also telling me that Super is also meeting the parameters of control as per Indes 110. So can I outrightly conclude that Super is the legal and the accounting acquirer?
Yes,
What do you
sir.
say?
Yes,
Yes,
sir.
sir.
Absolutely.
Yes, sir. Yes, sir. Since it is in our main three-step model also, on the
Correct.
step number 3, did the acquirer control over the business?
Yes. So in this particular case, undoubtedly it is a business combination as well. Rightly said that Super is getting a control over the business of Focus, which means that yes, he's satisfying the introduction 3 steps. And mainly, if I just focus on the concept of identifying the acquirer, the consideration is paid in cash and there is a new company created. So undoubtedly, legal accounting acquirer is same. Let's give you another question as well. That's also there in the study material. I'll have to give you this question in 2 different parts. I'll just take a snapshot and show you. So let's have a look at the first part of the question, then I'll take you to the second part. This is also there in the study material as well. It says to capitalize on economies of scale and earn synergy, entity Q contributes its wholly owned subsidiary, entity X, and entity R contributes its wholly owned subsidiary Y to a newly incorporated company Super. Is a new company created?
Yes, sir.
Yes. So basically what is happening that Q is giving his own subsidiary to the new company Super. and R is also giving its wholly owned subsidiary Y to Super. The two companies are contributing their subsidiaries, basically giving their subsidiaries to the new formed company Super. Super issues 200 shares to Q and 100 shares to R in exchange for transfer of shares in the respective business. So the consideration is paid in shares or the consideration is paid in cash.
Yes.
Correct. So can I, without even reading further, conclude that it would be a reverse acquisition?
Yes, sir.
No, sir.
Yes, undoubtedly, because in this particular case, a new company is created. We can
Okay.
see that Super is the new company created, and in this particular case, the consideration is in shares. So let me just focus at this stage. Out of 300 shares issued by Super, can you tell me what is the percentage shares which are given to each one of them? That is to Q and R. Super is issued 200 shares to Q and 100 shares to R. So can you convert this in percentage? How much percentage?
66.66%.
Correct. So we can say 66.67% is given to Q and 33.33 is given to R. So can I say that entity Q gets a control over Super and entity Q becomes a accounting acquirer, though the legal acquirer is Super? Is my thoughts correct? I think I'm absolutely correct indeed. I don't know if you're thinking too much indeed. You see, the focus is very simple. You have created a new company, Focus One. Your consideration is paid in shares. So naturally, the two companies Q and R are the shareholders of the company Super. So one of the two would definitely get a control. Or maybe both of them collectively get a control. It's always going to be a reverse acquisition. I hope I stand clear.
Yes,
Yes, sir.
sir. Yes, sir. True,
So,
sir.
yes, sir.
Great. Let's, I think, still take it further to give you the diagrammatic view as well.
But
So
the
let me now
accounting,
share the,
sir, accounting is a reverse accounting. However,
yes.
the accounting acquirer will be that X on that case.
Yeah, in this particular case, you can say the company Q is
Yeah,
the legal acquiree, but he's supposed to be accounting acquirer.
correct.
Super is supposed to be the legal acquirer, but he's going to be considered as the accounting acquiree.
Yes, sir.
Correct. So now we can see the diagrammatic position also, what we were discussing before and after the business combination. You can see before the business combination, the entity Q has got a 100% stake in X. The word X is missing. And entity R has got a 100% stake in Y. So basically, they've got two wholly owned subsidiaries. Now, what has happened in this case? The entity Q passed on the subsidiary X to Super. The company R, entity R passed on the subsidiary Y to Super, and in return, the entity Q is getting a 67% stake, and entity R is getting a 33% stake in Super. So can I say the diagram is very clearly telling me that entity Q has got a control over the company Super. So
Yes, yes,
can
sir.
Super be identified as acquirer in the business combination and apply the acquisition accounting? Yes. In this particular case, sorry, Super be identified? No. Super cannot be identified as the accounting acquirer. In this case, entity Q becomes you can say the accounting acquirer. So in this case, acquisition accounting would not apply, but a reverse acquisition accounting would be applicable.
Yes, sir. But super will be the legal acquirer.
Yes, Super is the legal acquirer, but not the accounting acquirer. Absolutely
Yes,
correct.
sir. Yes, sir.
So that takes care of my insights in terms of the step number 2, where I've given you the permutation combinations, and this is the most crucial step. So let me just remind you once again, when you focus on the question unrelated, related, if it is related, appendix C, generally, and if it is unrelated, depends. It could be acquisition accounting or reverse acquisition. And what decides acquisition or reverse acquisition accounting is mainly the step number 2. I hope you got the picture clear that your first focus is related, unrelated. And if it is unrelated, your second focus is the main step number 2, which will decide the fate, whether it is a case of acquisition or a reverse acquisition. I hope I'm clear on that picture.
Right, sir. The reverse accounting appendix B will
Yes,
apply.
sir.
Yes. Okay, now comes the third step, But I think before the third step, I think it's time to maybe give you a break as well, because that's going to take a little time. The third step is making a list of the net asset, which is a very crucial step, because you can get independent questions even on terms of the step number 3 as well. So I think let's first take a break. Let's get minds refreshed and then start the journey on our discussions on the step number 3. So I'll join you in around a 10, 12 minutes time. So relax your minds, then we start back. Enjoy your break. Yeah, it's working now.
Thank you, sir.
Thank you. I hope you had a relaxation of mind to take the journey forward. I think there is a small little question. So please tell me difference between accounting acquirer and a legal acquirer. I joined lately to class today. Thank you. Okay, let me, I think, tell you that. When you're looking at the concept of Ind AS 103, it works on substance over the legal form. So I think let me just illustrate that point to you further. Just to take you back on the same point, let's say there is a company A and let's say there is a company B. Let's say the number of shares of company A is 100 and the number of shares of company B is 60. Now A tells B that he's telling the shareholders of B that I will get a control over your company. So he tells the shareholders, I'll give you 2.5 shares for every one share held. So in this particular case, he's telling the shareholders of B that I will give you 150 shares against 60 shares of your company. Now look at the intention. Look at the basic intention so you can look at the substance over the legal form. Now in this particular case, the shareholders of A have got 100 shares in their company. But after giving 150 shares to the shareholders of B, the capital base increases and it becomes 250. When A will issue 150 shares to B, the capital base of the company A would increase to 250. Now, the shareholders of company A who were in 100% control of the company after giving shares to the shareholders of B has got now only a 40% stake in the company. Now, on the legal papers, if you look at the acquisition scheme, A will be called from the legal point of view that he is the acquirer. So we call him as a legal acquirer. But if you look at the substance over the legal form, that means you start looking at the accounting point of view. I would say if in the combined entity A shareholders have got a 40% stake, which means B shareholders have got a 60% stake. So in substance, we can say B is supposed to be the acquirer. So that's what we call substance over legal form. So from the legal perspective, you're saying that A is the legal acquirer. But if you look at the substance of the legal form, that is from the accounting point of view, I would say effectively B is become the acquirer. Because A has issued the shares to the shareholders of B in such a way that he loses a control and passes on the control to the shareholders of B. And that's what is called accounting acquirer. In simple word, substance over the legal form. I hope you got the dots connected on that, right? Okay,
Yes,
so
sir.
this was done. So now let's, I think, go on to the next inputs with you. Okay, that's perfect. So now I am coming back to the 7 steps on the acquisition accounting. So we have discussed the step number 1, which I said will be very apparent in the question. The date of acquisition will be, of course, very straightforward given to you. Then comes the case of step number 2, where we said the accounting acquirer, which is basically going to decide the fate whether it is an acquisition accounting or is it a case of reverse acquisition accounting. Now comes the most crucial step, and that is step number 3. Now, I would divide the step number 3 in terms of 2 sub-steps. I would say when you're focusing in terms of the step number 3, the first thing is locate if there is any tax rate given in the question. Because if there is a tax rate, it could lead to the creation of a deferred tax asset and liability in terms of 103. The reason is very simple, that when you are going to capture the net assets in the acquisition entry, they will be captured at a fair value. So the carrying amount for the purposes of Ind AS 12 is going to become the carrying amount, which is the fair value. But when you look at the tax base for the purpose of Ind AS 12, the tax base is not the fair value, but is going to be the cost minus the depreciation, which is the book value. And this would lead to a difference between the carrying amount, you can say, which is fair value, and the tax base, resulting in a deferred tax implication. So the first thing which you should do when you do a larger question in terms of step number 3 is first look at whether a tax rate is given in the question or not. So in step number A, we will see that whether a tax rate is given in the question or not. So when you read the question, you identify that yes, there is a tax rate given in the question, or you identify no, there is no tax rate given in the question. I think life becomes easy. If there is no tax rate given in the question, then in that particular case, no deferred tax implications. So in this particular case, Ind AS 12 will not apply. But if you say yes, a tax rate is given, then in that particular case, you need to be careful that Ind AS 12 is going to become applicable. So I think you already know Ind AS 12, but just to put it at the right place, what you are going to do. Consider each and every asset whose book value, or you can say the fair value, is now different compared to the tax base. So you need to make a list of all those assets and liability. You need to compare. You can say the fair value versus the tax base. Because the fair value for the purposes of Ind AS 103 is nothing but the carrying amount for Ind AS 12. So you will compare the carrying amount which is equal to the fair value versus the tax base, and this will give you what you already know is going to give you a taxable temporary difference, or it is going to give you a deductible temporary differences. So when you're going to compare this, we're going to get the taxable or the deductible temporary differences. So I'm just going to quickly give you the inputs in terms of Ind AS 12. So I would say, depending upon the asset or liability, the combinations would be something like this. So this is a pure application in terms of Ind AS 12, but it is applying in terms of 103. So if you look at the case of an asset and the carrying amount, which is the fair value, is supposed to be greater as compared to tax base. So can I say I'm going to get a taxable temporary differences resulting in a DTL?
Right,
So
sir.
this will lead, yes, this will lead to a taxable temporary differences resulting in a deferred tax liability.
Correct.
And if it is the other way around, you know that it is a deductible temporary differences resulting
DTA.
in a deferred tax asset.
Yes, sir.
And for liabilities, the position is absolutely reverse. Absolutely reverse of the asset. So if it is a case of a liability, we can say it is exactly opposite as compared to the concept of assets. Where the carrying amount is more, it means a deductible differences, a DTA, and so on. So this is what you need to take care in terms of step number 3A. When you confront a question, the first thing is just look into the presence of a tax rate. You can get the taxable deductible differences, get a DDA or a DDL. Okay. You want me to do a small little question on this area, or can we go to the step number 1B?
Yeah, we will have some small questions, sir.
Okay, so I think let me share a small question then on this particular area to you. I'll just share a question to you on the screen. This is one of the questions which came in the RTP as well. So this is purely on a step number 3A. Okay, I think I'll have to give the figures to you. I think the PDF is not carrying that question. I'll just quickly give you the inputs in terms of a small question. So let's look at a question on this particular aspect, step number 3A. So let's give you the basic data. So let's say, for example, I am given that on January 2020, let's say on 1st January 2020, let's say, for example, company H acquired 100% stake in company S. And that was for a purchase consideration, let's say to the extent of 15 lakhs. So I am also given some more information as well. And let's consider that I am given the tax rates. I'm also given the tax rates, and I'm given the tax rates in the jurisdiction of the parent company and in the jurisdiction of the subsidiary company. So let's say I am given the tax rates in the jurisdiction of the parent is 30%, and the tax rate in the jurisdiction of the subsidiary is supposed to be, let's say, 40%. And let's now also give you the further inputs as well. So let's give you a chart on the different assets and liability. So particulars, then I'll give you the book value. Then I'll also give you the tax base and the fair value as well. So three inputs, the book value, the tax base, and the fair value. So let's say we are given the land and building, and that is 600. This is all in terms of thousands. This is 500. And let's say this is 700. Similarly, we're given the property, plant, equipment. Let's say this is 250, this is 200, and this is 270. And let's say we're given the next item is inventory. So as far as inventory is concerned, it is, let's say 100 as well as 80. Then next we are given the account receivable. So account receivable, I am given it's 150 throughout. Account receivable is 150 throughout. And let's consider cash and cash equivalents. And that's 130 throughout. And we are given one liability as well, and that's accounts payable. And the accounts payable is 160 throughout. And there is another liability also given, which is retirement benefit obligations. I'm putting it as RB, retirement benefit obligations. And this is 100, this is nil, and this is 100. So this is the status of all the assets as well as liabilities which are arising at the time of business combination. Okay, so what is required to be done in this particular case? I am first of all required to calculate my deferred tax in this particular case. That is one agenda. And I think another thing which I want to do in this particular case is also calculate the goodwill. Or I think let's leave goodwill because we've not revised that part. Let's only concentrate on the calculation of the deferred tax in this particular case. Okay, so let me now ask you something point blank, and I think you can definitely vouch me. Tell me which two columns are you going to compare in order to exercise my step number 3A? Are you going to compare the book value and the tax base, or are you going to compare the fair value and the tax base?
I'm going to compare
Fair value
fair value versus
and
tax
tax.
base.
Absolutely correct. Because for the purpose of Index 103, the fair value in this particular case becomes the book value for Index 12, and we're going to compare the tax base as well. So I think let's collectively compare the information. Can I say, as far as the land and building is concerned, the difference of 200 will lead to DTL or a DTA?
Sir, it will lead to DTS.
So my carrying amount is greater as compared to the tax base, which means there is a taxable temporary difference resulting in a DTL, correct?
DTL.
Yes. So I'm not applied the tax rate. So for the time being, let me call it as a taxable temporary difference, TTD. Similarly, can I say for PPE, the difference would be resulting in a taxable temporary difference?
Yes, sir.
And as far as inventory is concerned, it is the other way around. So this will result in a deductible temporary difference.
Yes, sir.
Account receivable and cash equivalents are equal, so they would not result in any kind of differences in this particular case. So they are equal, so resulting in no deferred tax implication. Same goes for the accounts payable as well. But in terms of the retirement benefit obligations, the carrying amount is more. So this will be DTA, I mean deferred, deductible or taxable.
Deductible.
So that's right. So in this case, the carrying amount is more. So this 100 becomes a deductible temporary differences. So let's see what is the net difference in this case, the net taxable or the net deductible differences in this case. So this is supposed to be 20 and 100, that is 120.
120.
And this is 270.
Yes, sir.
So I guess net is 150, I think.
Yes, sir.
Okay, so we are getting a difference which is net to the extent of net taxable temporary differences, which is to the extent of 150. All the taxable and the deductible differences netted off. Now, the question is, what tax rate are you going to apply? Are you going to consider the tax rate for the parent company or for the subsidiary company? These are the assets and liabilities of the subsidiary.
Subsidiary company, 40%.
Correct. So 40% tax rate to be taken. So when you apply this 40%, you are going to get a 60, that is a DTL. Difference will lead to a deferred tax liability in this particular case. Wow. So I think that takes care of the applications in terms of the step number 3A. A pure application of Ind AS 12. Just compare the carrying value, which is effectively the fair value, versus the tax base, get the differences, and get the data done. Okay. So this was on step number 3A. Now comes the crucial step number 3B. So now comes the second sub-step of the step number 3, which is supposed to be step number 3B. Now, when you're considering the step number 3B, I would say there is one thing which you can keep in mind. So that you know, it is easy to track the differences which are there in the question. So what we can do is, we have got, let's say, the balance sheet of the acquiree. We've got the balance sheet of the accounting acquiree, and we've got the acquisition accounting entry. So we can keep the focus like this, that you've got the balance sheet of the acquiree on one hand, and your focus is the acquisition entry on the other hand. So in this particular case, let's imagine this is a T-shaped balance sheet. And let's imagine in the entry, we're just putting a short entry, that is net asset gets a debit. Purchase consideration, NCI gets a credit, and you will be getting a goodwill as a balancing figure. Now, your mind should be very clearly mapped that you need to consider, 3-4 items out here. Number one, let's number it and let's put it like this. Number one, can I say the assets and liabilities? The assets and liabilities which are appearing in the balance sheet of the acquiree, will they definitely go as a part of the acquisition entry? Yes. So whatever assets, liabilities are there in the balance sheet of the acquiree, 100% will go in the acquisition entry. But, so we can say what is appearing in the balance sheet of the acquiree will definitely become a part of the journal entry for sure. But there are two things which you need to keep in mind. Either they will be recorded at a fair value, or they may be recorded directly at a book value itself. So get the focus clear. I'm just giving you a crux. So whatever is appearing in the balance sheet of the acquiree is definitely going to be a part of the acquisition entry, generally always at a fair value. But then there is a possibility that the book value itself is taken out here. Would you like to remind me which particular exception could that be? Where you will take the book value of the asset directly and put it in the acquisition entry, no fair value. Can you recall what would be an example for this?
Land and building.
No. Yes.
Cash and cash equivalent.
No. I think that's a very simple example. We're not talking of that. We're talking of NCA held for sale. Because in the books of the acquiree, it would be captured as per Ind AS 105 at a fair value less cost to sell. So I cannot afford it to take it in the entry at a fair value. So this is going to be taken directly at a book value, non-current assets held for sale. That is one kind of exception. The second focus point which we need to consider in this particular case is that there might be items in the balance sheet of the company. They're not appearing in the balance sheet, but we are going to take them in the acquisition entry. So they are not appearing in the balance sheet, but we are going to take them in the acquisition entry. And here again, there will be two types, one which is taken at a fair value and one which is taken other than fair value. Can you give me at least one example for each one of them? Something which is not appearing in the balance sheet of the acquiree, but is undoubtedly a part of the acquisition entry at a fair value.
Goodwill.
That would be a balancing figure later, not goodwill. One very common thing which you find in the questions, which is captured as a part of the acquisition entry, not in the balance sheet of the query.
Sir,
NCI,
TTA, TTL.
Contingent liability that is taken at a fair value. So I think one of the best examples would be a contingent liability. The examples which I'm giving you are not exhaustive. I'm just giving you the most frequent kind of examples which you confront in this particular list. Because all the contingent liabilities which are not in the part of the balance sheet of a query will find place in the acquisition entry at a fair value, including any indemnification assets as well. So another example one can put is the indemnification assets. And you can even add to the list the intangible assets as well. Internally generated intangibles would not be a part of the balance sheet, but they would definitely be a part of the acquisition entry. So you can even add out here the intangible assets as well. Can you give me an example of those assets liability which are not in the balance sheet of the acquiree and they are appearing in the acquisition entry but not at the fair value? We just did that. We just did that. Step number 3A, deferred tax. This is the amount which is not in the balance sheet but is appearing in the entry at a fair value. So let me just, I think, club the inputs to you. When you go to attack a larger question, your mind should be working very clear that what is to be transferred in the acquisition entry. Basically, four things. Please watch this again. Let me connect the dots. Basically, four things, which I've divided into two broad categories. There are four items, but divided into two broad categories. Number one, what is in the balance sheet of the acquiree, can I say, will definitely appear in the acquisition entry. Let's get the focus clear. So whatever asset liability is in the balance sheet of the acquiree is definitely going to appear in the acquisition entry, but they may appear at a fair value generally. So the thumb rule is this point A. All the assets and liability in the balance sheet of acquiree will appear at a fair value in the acquisition entry. That's a thumb rule. But then there are exceptions. Assets and liability in the balance sheet of the acquiree may not appear at a fair value, but may directly appear at the same value. And one of the good exceptions is the non-current assets held for sale, because it is recorded in the balance sheet of the acquiree at a fair value less cost to sell, as per Ind AS 105. And I cannot afford to take it at a fair value in the acquisition entry. It is to be captured at the same value. The second block is we need to consider there will be a couple of assets and liability not in the balance sheet of the acquiree. Now we're looking at asset liability not in the balance sheet of the acquiree, but they are going to form part of the acquisition entry. Two things again. So they may appear at a fair value or they may appear at other than a fair value. So the best exceptions, what will appear at a fair value is the contingent liability, the indemnification assets, or even the intangible assets which are not in the balance sheet, which are not in the balance sheet of the acquiree because they were internally generated for him. Ind AS 38 prohibited him. But since the acquirer is going to take these assets, it becomes purchased intangible for him. So he's going to reflect them there. And in terms of the fourth category, that is asset liability not in the books, is appearing out here, but that's typically the deferred tax which you've taken care in step 3A, because whatever deferred tax you've taken in step 3A is going to be part of the list of the net assets. Right, friends, I hope I'm clear with the dots on step number 3A and B. We should definitely do a question on this area, I guess. Let me share you a different question, friends, on this. Just give me a second. I'll share you a little different question on this area, because this can be a very tricky kind of situation. So when you read the inputs, you need to be very careful that yes, he's talking of this. Just give me a second. there's a very interesting question. Just give me a second. I'll just locate that and share it to you on the screen.
Okay, sir. So I'm thinking why we are taking the book value of the NCA held for sale. See, once we classified the NCA held for sale, even we will
Yeah.
not provide depreciation also. Even we will not, the remeasurement also will not happen.
Yes.
So that
But
is
the
the
main
reason we are, yeah.
no, but the main issue is that you will, if I take it at a fair value, we'll land up violating Ind AS 105. So
Yeah, yeah.
Ind AS 103 cannot violate the principle laid down in 103, 105.
Right, sir.
Okay, I'm now going to give you a question which is going to be in two bits and parts, but it's a very interesting question. I think this will give us a good idea in terms of things. I'm just going to share that on the screen in two parts. Something different. Let's, I think, read this question. It says P purchased 60% shares of S on January X1. I guess a control stands acquired considering a 60% stake. At the acquisition date, the share capital of S and the retained earnings is given. A quick question to you. Is this the net assets on the acquisition date at a book value? He's telling me what is the share capital of S and the retained earnings of S on the date of acquisition. Can I call this as net assets at book value on the acquisition date? What do you say?
Yes,
Yes,
sir.
sir.
Undoubtedly, yes. I think if you're just having a little doubts in your mind, let me, I think, show you something. I'm just keeping the screen on, but you can just see some basic inputs. Just imagine a T-shaped balance sheet. Can I say we consider the assets out here, we consider the liabilities out here, and we consider the equity share capital as well as the other equity. Now you could take the assets minus liability and call it as a net assets, or you can take equity share capital plus other equity, call it as a net assets. I hope I'm making complete sense. So it says P purchased 60% shares in S, and on the acquisition date, the share capital and the retained earning is given. So we can say the net assets on acquisition date is supposed to be 2 lakh. The property, plant, equipment of S includes a land with a carrying amount of 10,000 but a fair value of 50. So what am I supposed to do now? If I want to get the net assets at a fair value, if I want to get the net assets at a fair value, what will you do with this difference of 10 and 50? Should I add it to the net assets at book value? Can I say the sum total of the 2 lakh is including the PPE at 10,000? Is that correct? When you took the sum total of the share capital and RE, is it indirectly considering the PPE at a book value of 10,000? Am I correct?
Yes, sir.
Absolutely yes. Absolutely yes.
No, no.
And then it says there is a fair value of 50, which means I now need to update another 40,000 as a part of the net assets to convert the net assets at book value to a fair value. Oh, friends, I'm making sense. I
Yes.
am getting a dangerous feeling. Clear with this point?
Sir, which means the 10,000 of the property and plant is inclusive of the 2 lakhs rupees.
Undoubtedly, because when you take the share capital plus RE, it is indirectly assets minus liability at a book value. So which means 2 lakh is including the 10,000. But if you're considering the assets at a fair value, so just imagine if you would have taken the revalued figure of PPE, can I say your other equity would have increased because of the revaluation surplus? Correct?
Yes, sir.
So indirectly, that 40,000, which is a book value, fair value difference, is to be captured as a part of the net assets. Then he says included in the intangible assets of S is goodwill, which arose on the purchase of trade and assets of a sole trader business. Now, the question is, when you are making the list of net assets, if there is already an existing goodwill as a part of the acquiree's balance sheet, should you consider or should you ignore?
Yeah, we will not consider because it already
Yes.
included.
Correct, because in this particular case, I will ultimately get the balancing figure goodwill when I compare the purchase consideration and the net assets. So any goodwill already in the balance sheet of the acquiree is going to be, so I'll reduce it. Then he says S.
Okay.
Then he says S has got internally generated brands, which is not recognized in accordance with IS 38. Actually, I've taken an international question. So you can read IS 38 as Ind AS 38. And the directors believe that the brand value has got 1,50,000. Are you going to consider this as a part of the list of net assets?
Yes, sir. We need to consider it.
Undoubtedly, because we said what is internally generated for the acquiree is supposed to be purchased for the acquirer. Interesting.
Okay.
So let me, I think, just organize the data till this stage. Can you see the board? Can I write it? Sharing the screen?
Yes, sir.
Yeah, it
Okay.
look like we are seeing in the deep well.
Because if I remove the question, then you will not be able to see the workings. So I'm just keeping it on the screen for the time being. Okay. So let me just, I think, quickly put the figures. I can say if I want the net assets at book value, can you tell me what is the net assets at book value? Sum total of the equity, share capital, and the RE?
Yeah, sum total of equity shares on the
2 lakh.
2 lakh.
That is 2 lakhs. So that is the net assets at a book value. Remember, this is net assets at a book value. But in step number 3, we need the net assets at a fair value.
Then we
So
need to
let's
add
begin with the
yeah.
journey.
Yeah, then we need to add 40,000. That
Very good.
fair
So
value.
I will add the, you can say, fair value versus the book value difference of the property, plant, equipment, and that is 40,000.
Yes, sir.
Because
Then
2 lakh is including 10, but it should include 50.
the intangible asset is a goodwill 20,000. We need not add because already
Yes,
is there
the
inside.
intangible assets goodwill needs to be eliminated because we will get the goodwill later as a balancing figure.
We won't
And
consider that.
the brands. Because what is internally generated for the acquiree becomes a purchased asset for the acquirer, and that's 1,50,000. I thought let's do something different from you. Why revise questions which you've already done in life? Let's give you something different. Let's now share you the second part of the question.
We thought that is the only question.
So let's have a look now on the second part of the question. I'm sharing that on the screen. It says, in accordance with Ind AS 37, the financial statements of S disclose the fact that customer is initiated legal proceedings against them. If the customer wins, which the lawyers have advised is unlikely, estimated damages would be 1 million. The fair value of this contingent liability is 1 lakh on the acquisition date. What are you going to do with this?
Sir,
Is it
we have
falling
to,
in my list that it is not in the balance sheet of the acquiree, but it is to be captured as a part of the acquisition entry at the fair value?
yes, sir. We need to incorporate as part of acquisition.
Absolutely. So reduce the contingent liability at a fair value in this particular case.
1 lakh.
Yes, that is 1 lakh. And then finally, it says directors of P are planning to close one of the divisions of S. And the directors estimate that this will cost 2 lakhs in redundancy payments. So what am I supposed to do with this redundancy payments, which they'll be paid on the closure of the division?
Okay.
Can I say this is something which will happen post business combination? Correct. Because they are wishing to close one of the divisions. So this is something which is not related on the acquisition date. So when you're creating the list of net assets, I am not supposed to consider the position which will happen post business combination, but we're going to consider only what is on the acquisition date. So what they're going to plan to do it says they wish to close. And let me also tell you one thing very clear. If you recall the provisions of Ind AS 37 as far as restructuring is concerned, can I say a provision for restructuring where redundancy payments are provided for can only be provided when a formal detailed plan is made and is formally communicated to the parties affected?
Yes,
Got my
sir.
point?
Yes, sir. Although the contingent liability criteria, it has to be determined and approved before the balance sheet date
Yes.
in order to recognize the provisions. Also,
So in this case, when they say that the directors wish to close the division, their wish is not supposed to be a formal communication of the things.
no.
So
Only in this case, we need not recognize the contingent liability. We can give the notes to the account. Notes to the account is
yes.
possible.
Yes. So in any case, what I'm trying to put is that in this case, there is no formal detailed plan which is communicated to the parties affected. So obligations will not trigger. So nothing to be taken in the net asset list. So I think that takes care of all the inputs in this case. So let's get what is the list of net assets in this case.
Sir, but I have one question. Why we are deducting 20,000 goodwill?
You see, at the end of the day, you go to compare the purchase consideration and the net assets and get goodwill as a balancing figure, right?
Right?
Now, just imagine that if you do the entry net assets, let's forget about the NCI for the time being. So if this net asset is including that goodwill of 20, can I say the balancing figure will get reduced by 20 automatically?
Yes, sir.
And if you
Sir?
do not take the goodwill, can I say automatically the balancing figure will include that goodwill?
Yes, sir.
So automatically it will come. So since we're going to take the goodwill as a balancing figure in the list of net assets, we're not going to consider any existing goodwill in the balance sheet of the acquiring.
Okay, in other way around, the goodwill what the existing entity consider, but we are not believing that way. We need to recompute.
Yeah, because in any case, I need to get the goodwill typically as a balancing figure. So I would just consider net assets other than goodwill and compare it with what I paid so that I get my purchase goodwill for my entry.
Yeah, even my CA inter also I have same doubt on this.
Okay. So let's consider this. This is, I think, 240 less 20 plus one other 150. And I think this is less. I think it's coming to 270 if I rightly calculate. Okay, so this is the inputs in terms of getting the list of the net assets. Okay, so this is done. But I guess I also want to just remind you that there is a small little inputs which I want to add on the contingent liability. Though I've not discussed all the exception list with you, but I think there is one point which I would like to pinpoint on the contingent liability before we take the journey forward. Not all contingent liabilities will be reflected as a part of the acquisition entry. It is only those contingent liabilities which are present obligation and which have got a fair value, which can be estimated as a fair value, will become a part of the acquisition entry. Because you must be remembering that as per Index 37, there are two types of contingent liability. One is a possible obligation and one is a present obligation. So Index 103 makes it very clear that when you capture the contingent liabilities as a part of the acquisition entry, you need to consider those contingent liability which are a present obligation, one, and whose fair value can be estimated, two. So I'm not going to capture any possible obligations as a part of the acquisition entry. Right, so I'm not taken all the exception list. I just give you a basic overview of the step number 3. This is not a comprehensive discussion of the list of net assets with you. Let me just quickly connect the dots and then go forward. So in terms of the step number 3A and in terms of the step number 3B, you've got two major focus points to decide. So when you're organizing the list of net assets at the first instance, see, are you given a tax rate or not? If you're not given a tax rate, that means no deferred tax implication. If you're given a tax rate, first of all, sit down before you make a list of the net assets. Identify all those assets and liability whose fair value and whose tax base is different. Because we need to get the taxable deductible differences and consequently the DTA DTL for all those assets and liability whose fair value, that is the book value, differs from the tax base. This is one exercise which you need to do before you get to the step number 3B. In terms of the step number 3B, just keep some basic structure in mind when you're solving a question. So the basic thumb rule is what is in the balance sheet of the acquiree will definitely come in the acquisition entry at a fair value. That is the basic thumb rule, that whatever is the balance sheet of the acquiree will definitely appear in the acquisition entry at a fair value. Then there are three more combinations to be seen. There are certain assets and liabilities in the balance sheet of the acquiree, but they appear in the acquisition entry, but not at a fair value, directly at a book value. Typically, you'll see only one: NCA held for sale. The third combination, the asset and liability is not in the balance sheet of the acquiree, but it is going to be a part of the acquisition entry. So you need to be careful on contingent liability. You need to be careful in terms of indemnification assets. You need to be careful in terms of any kind of, you can say, intangible. So you can see that when we did a question, we took the brands. That was an intangible assets. So when you see that it's not in the balance sheet of acquiree, but it's a part of the acquisition entry, contingent liability, intangible assets, mainly what are you going to see? Taken at fair value. And the fourth thing is asset liability not in the balance sheet of acquiree, but as a part of the acquisition entry, not at a fair value. And that's going to be typically what you've done in step 3A, that is a deferred tax asset liability. So 4 focus points should be there. What is here? That means balance sheet of acquiree is going to appear here. That is the acquisition entry, fair value. Number 2, maybe other than fair value. That makes it 2. What is not here can appear here in the acquisition entry at a fair value, contingent liability, intangible assets, or other than fair value, deferred tax. So I've given you the most important elements of items which you need to be careful of. I hope, friends, I am clear on the step number 3A and B. Right, so far so good. We go to the next step now. That is step number 4, the most crucial step indeed. So let's get on to the step number 4, which is on the calculation of the purchase consideration.
Sir,
Yes.
sir, could you please give me a quick intro on the indemnification of asset?
Okay. Let's consider, for example, that there is a court case against the acquiring company. So they've got a contingent liability. So I am going to capture this contingent liability in my books as an acquirer, correct? At a fair value.
Yes, sir.
Now, I tell the acquiring company that this is a liability against you. So tomorrow if the claim arises, boss, you need to compensate me for the claim. So the acquiring agrees to compensate you the money against the claim. So that becomes an indemnification asset for the acquirer. So that indemnification asset is going to be recorded against that contingent liability. So when you put the acquisition entry, the contingent liability will appear as an actual liability in the entry. The corresponding indemnification asset will appear as an asset in the entry. But the indemnification asset in any case cannot exceed more than the contingent liability fair value, because you cannot stand to get gain. So if you're getting a, you can say, a kind of a reimbursement against that contingent liability, that reimbursement becomes an indemnification asset, which cannot appear more than the value at which the contingent liability appears.
Right, sir. Right,
Got
sir.
the
Got
point?
it. Got
Okay.
it. Okay.
Wonderful. Okay, now comes the most crucial aspect, and that is the calculation of the purchase consideration. You can get independent questions just on the element of a purchase consideration. So what I have done as a larger picture, I have segregated the entire concept of purchase consideration in terms of 7 issues. Any question which you deal with, which is a larger question, you need to make a walkthrough on the 7 agendas I'll give you. And it's a very easy walkthrough. So let me first make a list of all the 7 issues which you can confront in a comprehensive question as far as a purchase consideration is concerned. So I'm dividing this entire discussion on the purchase consideration that there are a total of maximum of 7 issues which you can confront on the calculation of the purchase consideration. I'm going to give you short names so it is easy to remember the trail of thought as well. So one is called DC. That is called a deferred consideration. So DC, that is called a deferred consideration. Then the other one is called CC. That is called a contingent consideration. And there are 2 kinds of contingent consideration. One which is paid in the capacity of the shareholder. and one which is paid in the capacity of the employee. So I call it as CCS, what is paid in the capacity of the shareholder. And third is what we call CCE, which is paid in the capacity of the employee. So get the focus clear. You've got a DC, a deferred consideration. You've got a CCS, contingent consideration paid in the capacity of the shareholder. CCE, contingent consideration payable in the employee's capacity. Then we've got TC, transaction cost, that is called TC. Then there is PHI, that is previously held interest. There is PHI, the previously held interest. We saw that in the concentration test as well. Then the next is what we call SBP, share-based payments. And finally, we've got another agenda which is called pre-existing relationship. It is called pre-existing relationship, that is PER. Pre-existing relationship, that is PER. So when you're confronting the calculation of the purchase consideration, keep in mind that your mind should be running on 7 issues: DC, CCS, CCE, TC, PHI, SBP, and PER. I've written the short forms so that your mind gets tuned to this. Now, let's, I think, first of all, understand these 3 elements. Let's first understand these 3 elements put together. Because we need to consider the difference between a DC and a CCE as well as a CCS. So which I've created again a 3-step model. So let's see that what are we going to do in terms of this, a simple 3-step model. So first of all, you need to remind yourself that what is a difference between CC and a DC. DC means something which is payable in the future but is going to be paid for sure. Deferred consideration means something which is payable in the future but is going to be paid for sure. And CC means something which is payable in the future but it may or may not be paid. So a deferred consideration relates to the future, definitely to be paid. A contingent consideration is payable in the future but is based on ifs and buts. If the condition is met, you pay. If the condition is not met, you do not pay. So your first focus is going to be, is the payment going to be made? Is the payment going to be made in future? So first you need to focus on the point that is the payment going to be made in the future, because only if it is a payment in the future, it can be DC or it can be CC. So if you say a yes, I'll go to the step number 2. If you say a no, then it's neither DC nor CC. So what is important is the payment is going to be made in the future. So get the focus that you are going to make a payment in the future. If no, it's neither DC nor CC. And if you say a yes, then we go to the step number 2 to identify, is it dependent? Is it dependent upon any conditions? Is it dependent upon any conditions? So we will say that, is it dependent upon any conditions? So are there any ifs and buts, any conditions attached? If there are no conditions attached, it is a DC because it's a confirmed payment. But if there are conditions attached, then it is a CC because it is dependent upon the conditions, contingent. So when you say, yes, there are conditions, it is CC, and I go to step number 3. But if you say no conditions, it is DC. It is DC. And DC will be a part of the PC. Oh my God, what a wording's coming in. DC will be a part of the CC at a fair value. So if you reach a conclusion that it is a deferred consideration, a part of the PC at a fair value. What is the fair value? The fair value is supposed to be the present value of future payment. So whatever amount is going to be paid in the future, so the present value of the future payment is going to be taken as a part of the purchase consideration. And then we go to the step number 3. If the conditions are there, if there is ifs and buts conditions attached, we go to the step number 3. And in terms of the step number 3, you need to see what is the nature of the condition. You need to see what is the nature of the condition. Most of the times what will happen, the shareholder of the acquiring company is also the employee of the acquiring company. The shareholder of the acquiring company is also the employee of the acquiring company. So he's a shareholder come employee. So you need to see that when you're making a payment to him, then in that case, what is the capacity in which a payment is made? If you tell him that I'll give you this payment if you serve me for a certain number of years, you require him to be in a continuous employment, then it is paid in the capacity of employee. But the conditions attached is in terms of achieving conditions, but without requiring any employment. You don't want him to be in employment. You don't want to be in service. You just give him a condition, but that's not based on employment. Then it is paid in the capacity of the shareholder. So you need to see that what is the nature of the condition. So is the condition requiring a service? If it is not requiring a service, it is CCS, contingent in the capacity of the shareholder. But if there is a service which is required, then it is CCE, it is in the employee capacity. So if it is in the nature of shareholder's capacity, it's a part of the PC at a fair value. Remember Ind AS 103, where I said financial liability includes a contingent consideration as per Ind AS 103. That's the contingent consideration measured at a fair value and subsequently also measured at a fair value through P&L. I hope you recall the inputs, what we did in 103. That when you're considering the contingent consideration, it is arising on account of 103, but it is financial liability as per 109. And it is measured at FPTPL at each balance sheet date. If it is CCE in the nature of employee, it's not a part of the purchase consideration. Let me just connect the dots once again out here. So we said...
Sir, please explain on the third step alone once again.
Okay, I'm just consolidating all this input, no worry. So I'm just focusing on 3 elements of my purchase consideration. DC, something which is payable in the future for sure. CC, something which is payable in the future but is dependent upon ifs and buts. So you need to first of all zero down and identify number 1. C is the payment going to be made in the future. If it is not going to be made in the future, it's neither DC nor CC. Then I'm not considering this as a part of my PC. But if the payment is in future, you go to the step number 2 and see, are there any conditions attached on the payment? If there are no ifs and buts, it is a DC, confirm payment. Capture it at a fair value as a part of the PC. What is the fair value? Present value of the future payment. If there are any conditions attached, it is a contingent consideration. Then I go to the step number 3. Now, when you say that there are conditions attached, you need to see what kind of conditions are there. Are you telling the shareholder to be in service to get that amount? You're asking him to be in service. If you're asking him to be in service, it is paid in the capacity of an employee. But if you're not asking him to be in employment, it's a payment not dependent upon any services to be received, then it is paid in the capacity of shareholder. Remember, in this particular case, you need to keep one picture in mind. The shareholder of the acquiring company is also the employee of the acquiring company. So when you tell him to be in service, then I'll give you a payment. You say you be in service, meet the conditions, then I'll give you the money. It's paid in the employee's capacity, then it is not a part of the PC. It's a case of share-based payments if you're giving shares, and Ind AS 102 would apply. But if you're telling him that there are no conditions of service attached, you need to meet this condition. Let's say the turnover of the company, reaches this level, I'll give you the payment. So you don't need to be in service. If the turnover achieves that much, the profit achieves that criteria, then it is in the capacity of the shareholder. Then I'm going to consider the fair value. Right? Got the point?
Right, sir.
Great. So I think concentrate on a question on this area, then we'll talk of the other elements as well. Because I think it's important to understand in a question, is it supposed to be CC or DC? Then there is more things to be discussed as well. Let me, I think, first share a question to you. So I'm going to show you a question. You need to decide the status in this particular case. Okay, let me share a small little question. This is, I guess, in the study material as well. So I am taking this question from the study material. Let's have a look at this question. First of all, you need to decide is a DC or a CC, whatever, and then we'll decide if it is CC, in what capacity it is being paid. It says KKV acquires a 100% stake in Viva, a company owned by a single shareholder who is also the KMP in the company. So can I say the shareholder is the employee of the acquiree as well? So he
Yes.
is the shareholder come employee of the acquiree company, correct?
Yes, sir.
Absolutely. Then he says for a cash payment that is 20 million and a contingent payment of 2 million. The terms of the agreement provide for a payment of 2 years after the acquisition if the following conditions are met. Is the payment going to be made in the future, the 2 million?
Yes.
Absolutely. So I'm applying
Yes,
my
sir.
three-step
Absolutely.
model. So that
Yes, sir.
payment is made in 2 years' time. Is it based on any ifs and buts conditions?
Yes, conditions are mentioning. No? So
Yes. So we
Condition.
can say it is definitely a CC. Now, only thing to be seen is that is it CCE or is it a CCS?
CCE.
No, we yet to read the conditions. It says
20%.
EBITDA margin of the company after 2 years is 21%. The former shareholder continues to be employed with Viva for at least 2 years after the acquisition. No part of the contingent payment will be paid if the former shareholder does not complete 2 years employment.
Yeah,
So is the
CCE.
condition requiring you to be in service?
Yes.
Yes, sir. Yes, sir.
Yes. So is it CCE or a CCS?
CCE.
Absolutely correct. So is this going to be taken as a part of the purchase consideration? No.
No, we can't.
Great. So I think with this example, you get a little more idea that when you're looking at a DC or a CCES, how do you approach? Let's see one more. I'm not writing the answer for this kind of question. I think it's too easy and simple. Let's share another question to you, which is also there in the study material as well. And we'll decide whether it is a case of CC or DC, whatever. Have a look at this question. So I am given in this question, it says ABC acquires all the outstanding shares of XYZ in a business combination. XYZ has got 3 shareholders with equal shareholdings, 2 of whom are also senior level employees of XYZ. Is this again a case where the shareholders of the acquiree are employees of the acquiree as well?
Yes, sir.
Correct. And would continue as employee post acquisition of shares. He says the employee shareholder will receive 60 lakhs plus an additional payment of 1 lakh, 150 lakhs to 200 lakhs based on the multiple of earnings over the next 2 years. The non-employee shareholders will receive 100 lakh. He is making a different payment to the employee shareholders and he's making a different payment to the non-employee shareholders. So shareholders of the acquiring company are in 2 categories. One who are employees as well, one who are not employees. The additional payment of each of these employee shareholders will be forfeited if they leave the employment at any time during the next 2 years following the acquisition by ABC. The salary received by them is considered reasonable for the services. So let me put the three questions. Number one, is the payment made in the future?
Yes, sir.
Yes, indeed. Is the payment based on any ifs and buts conditions?
Yes, sir.
Employment
Yes.
condition.
And is there any employment condition attached?
Yes.
Yes. So does this become a CCE or a CCS?
CCE.
That's right. So that would not be a part of the PC. By the way, let me also ask another question as well. The employee shareholders are getting 60 lakhs of cash payment. Would that be a part of PC?
Can you
Yes, sir.
repeat the
Yes.
question?
It
The
will,
amount of
Yes, sir.
60 lakhs which you're giving, is that a part of PC? Undoubtedly, yes. But is that 150 to 200 lakhs, which is based on ifs and buts, that is not a part of PC. And then the non-employee shareholders are receiving 100 lakhs of payment. Can I say, is that a part of PC?
Yes, sir.
Yes, that is a part of PC because that is not based on any ifs and buts. So any payment which is given without any ifs and buts, of course, is paid today. That is a part of the purchase consideration. I hope with this we become more clear on CC, DC, and other factors. Right,
Sir,
friends?
sir, whether the shareholder is the employee or not employee, that's not a matter. If there is no condition to receive the money, then we will include in PC.
Correct. So you mean to say that if I am looking at the concept of DC, I don't
Yes.
care whether he's employee or not? Yes, because it's a confirmed payment. It's only that it is paid in the future, but there are no ifs and buts. So DC, I don't worry about employee or non-employee. But in terms of CC, I'm definitely concerned whether it is going to be in what capacity. Great. Now let's, I think, consider the other two elements as well. The first one is the concept of TC, that is a transaction cost. It's never considered a part of the PC. The transaction cost is supposed to be immediately expensed. It is when you acquire an asset, the TC gets added to the cost of the asset. Remember the financial instruments, financial assets. But if it is a case of a transaction cost in a business combination, it's not a part of PC. It is simply expensed off immediately. It is expensed off immediately in the profit and loss account. Now, there are some very interesting questions on PHI, but let me first tell you something very basic. We'll get into the details on this later. As far as PHI is concerned, it is definitely a part of PC at a fair value. If the company acquires, if the company has acquired some percentage of stake in the acquiry earlier without getting a control, maybe a passive investment, maybe a significant influence, and now it is getting a control in the company, then all the previously held interest is a part of the PC at a fair value. So you can notice something very interesting indeed. Part of PC at fair value, part of PC at fair value, not a part, not a part of PC at fair value. So when you are considering a purchase consideration, everything is being taken as a part of the PC. If it is not, it is not. If it is, then it is a part of the purchase consideration. Now, this needs a little more elaborative discussions, and this needs more elaborative discussions, though I'm not done with the PHI as well. But I think since the time is less, let's do something. Let's put some rapid fire questions on the discussion so far. Then I can just add one more element, but I'll make an interesting chart on that, not today, in the next session. Tomorrow is going to be very interesting because we'll do a lot of questions on this area as well. So let me now put some rapid fire questions to you. If there is a payment in the future without ifs and buts, what is it?
DC.
Very
DC.
good.
DC, then we need to the future value record the present value of the future payment.
Wonderful indeed. Now I want to add some element further. If you're going to consider the DC as a part of PC, is it going to lead to unwinding of discount in the future?
Yes, sir.
Very good. That makes the subsequent accounting of DC also relevant. Let's go further. If there is a payment which is given to the employee shareholder in the capacity of the employee, undoubtedly it is CCE.
Yes.
Is it a financial liability? Yes. So you're going to capture it at a fair value. Is there any subsequent accounting to be done as well? financial liability as per 109 measured at FPTPL. Got my point?
Yes, sir.
So, which means DC results in a subsequent unwinding of discount. CCS results in the fair value remeasurements at each balance sheet date. This is not a part of PC, so I'm not concerned. Can I say PHI means revaluation of the previous investment? Would that also result in a gain or loss on the PHI?
Yes, sir.
Because this investment would have been recorded at a fair value and now, sorry, at a book value, and now it is updated at a fair value. But how is that going to be tackled? We'll discuss in detail. So, as far as these three elements are concerned, PHI, SBP, pre existing relationship, that we will discuss tomorrow. The journey continues.
Sir, I have one question with respect to
Yes,
TC.
please.
Yeah, TC transaction that cost if is incurred by the acquiree and acquirer. Sir, we are talking about the acquirer part here.
Yes, this is the transaction cost incurred by the acquirer, not acquiree. Why would acquiree incur a transaction cost? He's selling a business.
So whatever we are discussing here, sir, is relating to acquiry company,
Acquirer. We are discussing the acquisition entry to remind you in the books of the accounting acquirer. So all this is relevant from the acquirer point of view.
But income tax you will calculate in the target company.
No, here also you can call it as a target company, but we don't use the word target company as per 103. Even in AFM, I guess advanced financial management, we call that as a target company. That's the technical language in finance. But here we call it as, acquirer, acquiree.
Acquired.
Right, sir.
Right, friends. So I think that brings us to the end of the journey for the day. So we're going to continue the trail tomorrow morning. So enjoy your weekend, enjoy your Sunday, and see you tomorrow morning. Thank you very much. Bye-bye and take care.
Thank you,
Sir,
sir. Thank you.
sir,
I
it is
don't,
really interesting, sir. Thank you so much.
sir,
Thank you very much.
I don't see it is a revisionary class. It's a full-fledged class.
Yes,
I am
really.
trying to, incorporate the revisions along with the questions as well, trying to condense whatever possible we can do. Thank you very much indeed.
Thank you.
Thank you so
Thank
much,
you.
sir. Lovely.
Thank you very much. Anji.